Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
Bedford's Cost Segregation specializes in generating significant tax savings via their engineering-based studies for commercial real estate clients nationwide. Founded in 2002, Bedford is one of the largest independently owned cost segregation providers in the country, with over 14,000 studies completed to date in multiple offices throughout. The most important decision ownership can make when incorporating cost segregation within their real estate portfolio is selecting the right provider. With only 43 certified cost segregation professionals nationwide, Bedford is proud to employ 8 of them and takes the quality of their people as seriously as their studies. Every certified cost segregation professional has passed a rigorous test combining knowledge of technical engineering issues, legal tax issues, ethics standards, and requires a strict level of prior work experience to be eligible. Bottom line, not all cost segregation providers are created equal. So be sure to take the decision seriously from the beginning to protect yourself for years to come. Please contact Bedford's Business Development Director, Frank GIUDICI, to learn more. This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Michael Becker, but it is a continuation of yesterday's show. We were having a great conversation. He is such a powerhouse, in our industry, and has been so successful. So it's been a great conversation. It went a little long though, so we decided to split it up into 2 days. Also had some computer difficulties, and so we split the show. But I hope you have enjoyed these episodes with him as we talk through many things about the issues in Texas right now, through the unexpected cold weather and freezing that they had, and having 300 units that have issues and tenants that have issues with no power and water and all those things. So I hope you are enjoying this show, and I hope you are learning a lot and growing your business, whether you are a passive investor or an operator, either one. I hope you are learning a lot. Reach out to me if I can help you in any way. You can always email us, info@lifebridgecapital.com. If you have any feedback, I would be very grateful. Have a blessed day and enjoy the show. All right. I thought we could just roll right into like how this has helped you prepare for a downturn, or what you've learned, and then moving forward, and how you prepare for a downturn in general. Does that work?
So yeah, Whitney, ever since we kind of got into the second part of 2020, we with the first COVID really kind of on the transactional side, on the investment sales side, really kind of killed all the momentum that we kind of had going into 2020. It was a really good first 2 months of the year for us personally, and I know a lot of people I know. Then all of a sudden everything kind of ground to a halt in March, and we kind of took 90 to 120 days off, and then kind of June, July came back around and started kind of seeing a little trickle, and then really kind of towards the latter part of the third quarter, and really kind of the fourth quarter of 2020 to now, it's been kind of back like business as usual in a lot of ways. I mean, the interest rates are, quite a bit lower than what they were. I know here in real time, they're kind of creeping up, at least on the long end of the curve. The 10-year treasuries kind of tick back up a little bit, which is probably going to, if that keeps going, that'll probably have some level of impact at some point. It really hasn't yet on pricing, but it seemed like that, the fourth quarter trades really weren't very impacted very much by COVID. I mean, the cap rates were pretty much the same, even though the interest rates were down, probably a third, maybe more from what they were kind of going into the lockdowns. And it kind of seemed like to me, we got 3 deals kind of post COVID in 2020, and felt like we were getting pretty good buys. We're getting really good loans, and our cash on cash was better because our debt was just better. Interest rates were better. And kind of felt like as we were entering or finishing up 2020, it felt like either one or two things were going to have to happen. Either interest rates were going to go up or cap rates were going to go down. And as we are in 2021, we now will set a deal late last year, or set 2 deals late last year. We closed one about a week ago and closing one this week. So we're going to have a second skin on the wall this year. And in real time right now, as I'm looking, we have a 1031 we're trying to go place. Real time right now, it feels like cap rates are compressing, and pricing is going up. And it's just, we have all these different market participants coming in. Well, all the same people that have been here are still here. We got a bunch of extra people coming in from both of the coasts, really trying to come to the Texas market. I'm sure Florida, Arizona, Carolinas, I'm sure they're getting their fair share as well. And then we're starting to see some other people that traditionally have played in the industrial, not so much industrial, but the hospitality, office, and retail space. Those are kind of generally uninvestable, especially on an institutional basis right now. So a lot of that money is flowing into multifamily and industrial. So it feels like in real time right now, first quarter 2021, we are seeing cap rates compress, prices accelerating. That's kind of what it feels like right now.
So, Michael, I'd love for you to answer this. I ask every operator that comes on the show, and just from your level of experience, I'd love to hear just your thoughts on this as well. But being prepared for a downturn, and I like asking how do they prepare for a downturn? What is it that's like non-negotiable things for you? But even going through this last year, what maybe you can speak to some things that you already had in place beforehand that helped you to be affected, as little as possible through a pandemic, and then even moving forward, maybe things that have changed or things you put in place since then.
Yeah, I mean, I think some of the things that really were helpful that really helped us over the last 12 months. One, I think we kind of were on a mission of selling kind of old, buying new, so we kind of transitioned out of some older, tougher stuff that we had. We never really had much in high crime locations. That was always something I was really particular about on location. So, but the delinquency problems that we did have, they were a little bit more concentrated within the workforce housing. So that proved to be a little bit wise or helpful from a collection standpoint. Not saying that I think people that had, good located, well maintained workforce housing, I don't think they really had too many problems, but, they did have a little bit more delinquency issues there. Making sure we had the good, proper management teams in place. So I felt really good that, we tested the management teams and they handled it really well. Extremely proactive, asking for money every day, basically knocking on doors and continuing to ask for some money. And that was really helpful. I like most people working with some payment plans for the residents, making sure they had resources to get all the state and local and charities and these various places to kind of help them with some rental assistance until the government programs really started kicking in just now. And then, and obviously, in addition to that, my firm, my partner and I, we did a rent relief fund, and we probably put up, 60, 70,000 of our own money. And then we had some of our investors pitch into that. So we'd help some residents to pay a portion of their rents as well. So that kind of really helped keep some of these people that otherwise are good residents just kind of hit a little hard spot. They helped those people kind of get through it for a few months. So I felt pretty good about that. And then kind of, just structurally the way we set these deals up, when we first started out, we had a lot of fixed rate mortgages. So, we didn't really have any kind of rate risk on those. Those turned out to be a bad decision because rates kept going down and down and down. And then some of the last, 2 or 3 years, we did a lot of adjustable rate mortgages. And those deals really, really have shined the last 12 months. So Whitney, because, LIBOR went from, 2% to, 0.15%. So, we got, almost 200 basis points or 2% of interest savings in some cases on these deals. And so, our interest rates got cut like in half in a lot of cases. And it really, at the time where you were a little worried about the durability of your income and actually being able to collect some money, that's extremely helpful. So, some of these deals we're just basically printing money. I mean, we're making more money today than we ever have. It's just a function that our debt service is cut in half. So that was extremely helpful. So some lessons learned. I mean, I think, if you take the floating rate, having maybe a little bit lower leverage, I think that certainly is helpful because, it went in my favor this time, but it could go against me another time. But, generally, if you're in a recession, the Fed is going to cut rates. They don't really raise rates in economic stress. They raise rates when the economy is going, well and booming. So if you hit a recession, having an adjustable rate mortgage, in theory, you should see rate cuts and see some relief within your amount you have to pay. Very communicative with all the lenders. Fortunately, we didn't need to really get anything from the lenders at the end of the day, but at the front, it was at the front end of the deal. It was like, we're going to have to get in forbearance, and no one really knew. Being really proactive about collecting money, setting the deal up right, not being over leveraged, and making sure we had a proper working capital. We had early in my career, a couple of the deals we did, we never had any major issues, but we came in maybe a little light on some working capital on a handful of deals. Those deals always kind of, just a little bit harder to get through your business plan. You don't really have the margin for error. So after making that kind of minor mistake a few times, every deal we do now, we come in, with an abundance of working capital. So we have enough money to do everything we need to do, plus some, just in case money, if something that you didn't expect, like the, power grid shut down for 2 days in Texas in the middle of a cold snap hits, we have enough money to go fix a bunch of sheetrock and carpets and things like that. So having proper working capital certainly would be something I think that a lot of people make a mistake on.
I've seen it many times. I've not been in this business near as long as you, but one thing that's very important to us is have a just massive reserve budget from day one. Is there a way that you calculate that, a rule of thumb that says, what, we want this much, you said, a proper working capital, or, is that separate from an emergency fund or reserve budget?
Yeah, I mean, you have your capital expenditure budget, which, there's going to be rolled in the loan or you self-escrow. So that's one thing. So if you self-escrow, it kind of can double up a little bit. So, you have this money to go do a bunch of renovations. But if you hit unexpected issue, you can tap your self-escrowed CapEx. So now if it's escrow with the lender, you don't have access to that. So it's a different story. But, usually we try to plug in, $100,000 at minimum. And then on top of that, I'll usually kind of roll in, most of these deals we're having $200,000-$300,000. And then when you close, you're generally getting rent prorations and you kind of prepay your first month's interest. So then before you actually make a mortgage payment, you have two rounds of collections before you actually pay your mortgage bill. So usually your expenses are kind of 30 days in arrears in most cases. So usually probably 80% of the money you collect in that first rent check is going to go to your bottom line as well. So, I think if you come in with $100,000 to $300,000, depending on the size of the deal, I guess if it's a smaller deal, you maybe cut that down. I probably should have a better answer on that. I don't really have a rule of thumb, but I think about it as, just want to make sure I have plenty of money. Plus I know I'm going to get that first round of collections where I don't really have a lot of expenses. So I'll be able to kind of pad that working capital. And usually we wait 2 to 3 months before we start up distributions anyways. So we're getting, hopefully some additional working capital is kind of built up by just not paying out the distributions for the first 2-3 months. It's kind of retaining the free cash flow.
Yeah. So, and with as many projects as you have, I know something we've debated about, and I'd love to get your thoughts on this. Like after you've done numerous deals and you have all these reserve budgets, like that's a lot of capital just sitting there. Right. Yep. And you can't, intermingle the funds, or you can't, but is there a way that you found to better use that capital? I mean, as opposed to just, millions literally just sitting there in these accounts.
Yeah, no, I wish you had a better idea. Maybe we should have bought Bitcoin a couple of years ago, and that would have made some money.
Right.
But it sits there in the checking account, and then the last, almost a whole year now. When you do any sort of Fannie or Freddie loan, they're putting these COVID reserves on top of it. So right. we did a pretty large loan last year, and we had $2.6 million in COVID escrows on top of the normal escrows. And so just sitting there dead money that, it's just in case. So it's a little bit challenging, and it's not earning any interest. Or if you do put it in a money market account, you're going to get, 25 basis points or something like that. So it's pretty negligible. But I think it's just part of being a prudent owner, just having it. You just gotta suck it up a little bit. But yeah, if you come up with something genius that doesn't have the risk of the Bitcoin, otherwise I guess maybe buy some Bitcoin.
Yeah, I know you have to abide by your operating agreement, things you've set in place with your investors. But I just wondered, after doing that many deals, because it's just a lot of capital. My business partner and I've thought about it often. It's just shame all that's just sitting there, but you need it. You would need it there in case you need it, right? That's why it's there. But what do you predict, Michael, in the real estate market over the next 6 to 12 months? And how are you looking at deals? Or are you looking at them differently than you did, say, a year ago?
Everything's getting tighter and more challenging, and especially as we're buying nicer stuff. We're being able to compete pretty well with institutions. We got a little bit more of the entrepreneurial setup and spirit, and go a little quicker than some of these people. So we're able to buy some nice stuff. I'm actually looking at it. We have a 1031 exchange for a client. Like right now, I'm hoping today to hear back that we won a $70+ million deal down in Austin, and And you would probably think I'm crazy, but we're maybe I am. Maybe this is going to be a terrible mistake about what you're about to do, but we're hopefully going to buy a deal about high 220s a door, really brand new deal, real nice, real good part of town. But it's got to be like a sub 3 cap because their historical information, our historical operating numbers suck because there were some concessions on this and that. So we're kind of having to work through the numbers and kind of bet on the come a little bit and kind of look at the pro forma a little bit. But I'm seeing like what replacement cost is. So they like the developer couldn't put this building on the ground for any less than $250 today. Plus they got to make a profit on top of that. So I feel like I'm buying it for $20,000 or so below replacement costs because the cost has just escalated so much between labor and lumber's at like all-time highs, and copper shot up like 6% yesterday. I mean, all these raw materials, the input values are going into these deals are going up and up and up and up. So I feel like we're buying it below replacement cost. So either the developers rents are going to have to rise and concessions go away to make these deals make sense. So the developers are going to stop building because they can't make this make sense. So they can't lose money over and over and again and keep attracting capital. So it feels like it's a pretty good bet because it's going to come, and we have a little different math with the 1031. So that's kind of what we're doing there. And then on the workforce housing stuff, I mean, it's just, man, it's tough to pay the same cap on a workforce housing deal that you can for something that's 5 years old. Yeah, right. At least to me, I know you got the upside in them, and it seems like that risk is mispriced to me. So it's challenging to make some of these deals make sense, and so we're just trying to find what we think is a relative value to current market, and continue to when we put these deals out, you got to produce some level of yield along the way, which is certainly not what it was a few years ago. Make sure you get the proper amount of debt. Don't over leverage the deal. I see a lot of people maybe trying to amp up the leverage, maybe strip in some preferred equity or some mezzanine financing behind it to really kind of increase the leverage and juice the IRR returns for their investors. So trying to stay away from doing stuff like that. We've never done that, and I'm just trying to stay away from that. I recommend other people do, and just kind of be really diligent. And I found by doing enough of these deals, Whitney, there's always a deal. There's always a deal relative to current market. How hard are you willing to work into it? It's a completely unfair business. It's who what chips you can trade. People do business with people they know, like, and trust. So if you could get that trust and these brokers to like you because the brokers control the deals, that's kind of really where you find your edge. And trying to get in and just look at everything in the market that you're in. Or, a couple markets that you're in, just look at everything. You need to be looking at everything. And the answer is always, when you can't find a deal, the answer is always you got to just do more. You just got to work harder. You got to look at more deals. And eventually one of them is going to make sense. And it's going to be a value relative to everything else.
What about a couple of daily habits that you're disciplined about that have helped you achieve success?
I wish I was a little bit more disciplined and had a morning routine and a lot of stuff like other people do, meditate and stuff like that. But I think that what I do well, Whitney, is I kind of realize where my north is, right? My compass, I know where I want to go, and I'm not perfect. I'll get distracted. I'll do certain things. I'll kind of go down a rabbit hole and burn a half an hour of my life in the middle of the day, not being very productive. I kind of snap out of it because I know at the end of the day, to do what I do, I got a lot of responsibility on me. We got to do a lot of stuff. But at the end of the day, if you do what I do, or what you do for a living, the way you make money is you got to find deals and you got to find capital, right? So find money, find deals, and everything else is sort of noise. It's important. You got to make sure you get all your K1s out like we just did, and asset manage and deal with breaks if the temperatures close but are low. But I mean, at the end of the day, you got to find deals and find money. So if I find myself doing a bunch of low value tasks, I try to find a way to get that off of me with either a system or another employee or resource or something. So I'm like constantly like snapping myself out of it. If I start wasting time and doing stuff that's not really driving the greater mission of my company, I'll like stop it, course correct, and just focus on the highest value task. So I think I do a pretty good job about being self-aware and not letting myself go too far down the rabbit hole and stuff that doesn't really matter.
No, that's a skill that most struggle with, or maybe everybody does at some point. But that's a great skill to have. And on that note, you talked about when people say, we can't find a deal, and you just have to look at more deals, underwrite more deals, all those things. But then you mentioned about finding investors. What is your best source for meeting new investors right now?
It's we kind of get 1A really is through the podcast. I was a co-host of Old Capital podcast for the last 6 years. So probably where you first met me. A lot of people might know me from that. And then kind of my new show, the Multifamily Investor Show, Michael Becker. So I get several people a week off of that. And then 1A is probably just referrals from our existing database. When you do well by people for several years, they refer their friends and family, and kind of goes out from that way. So wish we were just about to hire a marketing person. I have been kind of doing all this bootstrap without really any professional help. So I think we're about to find someone to finally help me kind of do this in a little bit more professional way, and be a little bit more strategic about how we go about it. But I think, really, if you're starting out, if you don't have a podcast or track record, going to local meetups. I think that's about to be a thing again, where we haven't done it for a while now. I think that's about to be a thing again. So you got to get out. I say this, the last year's kind of challenged my little saying, but I think it's really true at the end of the day. This is a business you can't do 100% behind your, at your house or at your office behind your computer. You got to get out. You got to meet people. You got to network with people, going to conferences, speaking at events. Those are just things that you just got to do. So whether you have a big track record or not, if you host a little meetup, it's all a relative business. If I've done one deal and you've done 0 deals, I'm 100% more experienced than you, even if I've only done one deal. So hosting a meetup, getting some guest speakers in, starting this out, I used to joke with Paul Peoples, the co-host of Old Capital podcast with me. And, when we first started out, we had, dozens and dozens of listeners, we had basically no one listening to us. And just kind of over time, it just kind of builds and get a little bit of inertia to it. Now we get, 40, 50,000 downloads a month on, a very dry subject like apartment investing and apartment financing. So it's a very niche topic. And, just kind of about being consistent, showing up, doing the right things over and over again. And over time, it kind of will work out for you. But those people that aren't consistent, that don't put the work in, they tend to not, get the results that they want. And kudos to you doing, 900 shows pretty much basically every day, right? So it's every day.
It is every day.
900 days, almost 900 days now. You've been putting content out, and I can promise you, from a guy that doesn't do nearly that volume, it's a heck of a lot of work. So kudos to you. And if you could do, 1/10 of what Whitney does, you'll probably be pretty successful.
I appreciate that, Michael. And yeah, and by the way, it is a great podcast, Old Capital podcast. That probably is where I first heard you. And then, we've met at the Old Capital event a couple of times. But what is the number one thing that's contributed to your success?
Like I said, I think I'm pretty self-aware. I'm not the smartest guy in the world. Not that I'm dumb, but I'm not the smartest guy in the world. It took a little while to get out of college. I was in college for 8 years. So my joke is I beat Tommy Boy by a year, right? I was kind of listless for a little while, or worked full time, went to night school, and I got out, and I had a sub 3.0 GPA. I think it was like a 2.7 when I graduated. So, but then I got into work. I always had a good work ethic. And then I really just I'll work hard. I'll focus on stuff. I'll really knuckle down. I don't give up very easily. So, I stick with it. I got a good work ethic. I work hard. So I think some combination of hard work and, just being dumb enough to not give up and just kind of sticking with it. I think that goes a long way in this business. And, what I like about the business is really, really simple, is you gotta buy a deal, you can produce some cash flow, force some value in it by doing some strategic renovations, so you buy it here, you get good debt on it, get your tenants to pay your mortgage and all your expenses, and get a little cash flow left over. So it's really, really simple. It's not always easy. You got problems, you can mess it up for sure, but focus on something that's really, really simple and just kind of do the same thing over and over again. I kind of become a real master at it. So I think the people that get kind of the shiny nickel syndrome, where they do, self-storage this day and land development the next day and apartments and mobile homes and Airbnb and all that stuff, they never really get good at any one thing. So I found that riches are niches, and find your one thing, work hard, focus on it, and make sure it's a simple, understandable business. I think you could be pretty successful, whether it's multifamily or some other variation of real estate or an operating business. At the end of the day, you could be a pizza delivery company or something, as long as you work hard at it.
Some very wise words. Michael, I'm grateful for your time. And it's always an honor to have you on the show. Just somebody with your level of experience and expertise. There's just many great discussions that we've had over the last, half hour or so. So I'm just grateful to hear just how you have managed all, 6,000 units and 300 that were affected, over the last week, but then even the pandemic over the last year, and just how you prepared for that and preparing for a downturn and talking about proper working capital amongst many other things that have allowed you to be successful in this space. So thank you again. How can the listeners get in touch with you and learn more about you?
Yeah, the two resources I'll give out right here is, the new show I started, which is the Multifamily Investing Show of Michael Becker. So again, that's a highly produced show. It's in a studio. I try to get pretty high level guests. So, brokers that sell billions of dollars of real estate and owners that own, thousands, if not tens of thousands of units. So it's been kind of my new little passion project. So you can find that on, like I said, YouTube, iTunes, Stitcher, where you probably anywhere you hear my voice now, or our website is www.multifamilyinvestingshow.com, or my company that I run and operate is SPI Advisory. So you can go to our website, which is www.spiadvisory.com. There's a contact us form. You fill that out, and I'm always happy to send out information for people who want to learn a little bit more about us and potentially work with us.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.